Hey everybody, this is Jose Blasco. We are about to get started. A bit late with my sound check. Please quick message on the chat box so I know we are ready to get started. The countdown just reached 0. I believe all is good to get started, but just a quick confirmation with you guys. I will turn on the video stream on the bottom right of the corner of the bottom right corner of the screen. I meant to say, as I always do. How are you, my friends? And I'm just gonna wait for a couple of extra confirmations on the chat boxes so I know everyone is ready to begin. Everyone, thank you so much. Joanne, Siderman, how are you, my friends? Everyone, good. So welcome everybody. Sorry for having this slightly delayed sound check. How are you, Maka? Good to see you. Today is September 29, 2021. My name is Jose Blasco. This is Options with Options. How are you, Christian? How are you, Joe? We are going to be trading options, isn't it? And as always, the plan, I'm going to display that on the screen in a moment. But before that, disclaimer, please read it carefully, is in the upper left side of the screen. This is important information. If you have attended the sessions before, probably you are aware. But even if you're aware, please go ahead and read it carefully. Thank you so much, guys. So when it comes to agenda for today, we're going to be looking at the market. From there, we'll move into reviewing the trades that we have and talk about trade management. From there, we'll move into trade execution, looking for new opportunities. And that's the plan for today. Almost always the same structure because trading is all about being mechanical on the approach. And in this case, I'm trying to do the same on how we run the sessions, guys. Here we go. So here is the S&P. Here is top. We are now ready to begin our analysis. Guys, feel free to comment, feel free to interact during the session. Please do not be shy. Please do not be a stranger. Type your questions so we can help you much better into wherever you are in your trading journey. And indeed, we've seen some volatility in the marketplace recently, up and down, actually, in both directions. And therefore, you may have challenges, you may have questions, whatever that is, make sure you phrase it so we can help you better, okay? Now, let's begin with the analysis of the market. So what is it that we have? Well, after a very, very, lengthy climate that surpassed what probability suggested of two candles on the way down and, went for, like 5 times more of that, which was extremely unexpected from a probability point of view. After that, we went back to blue, and blue means that we were supposed to be in a climate moving up for 6 candles. Guess what? Not only the climate never confirmed. Okay, so all of those 3 dots are thin dots. They were not thick like those dots here. On top of that, we only got 3 dots, and now we are back to red. Okay, so of course, probably the strong fundamentals, especially with the news yesterday related to everything about budgets and everything else. So probably is a catalyst for many on-field orders to be cancelled and the market to start free falling. And definitely this has changed the climate. Again, is it scary to see a very big candle like that? Well, to some people it is. But again, we need to keep cool. We need to keep mechanical in our approach to analyzing the market so we can trade mechanically. And in this case, what we got is one red candle in the context of a confirmed down climate, which statistically should last for 2 candles. Okay, so that's what we got. Could it last a bit more? Could be. Probability suggests 2 candles. Okay, and also something that may make it last just a little more would be 2 things actually. Number one, the fact that we got an Elliott wave turning point confirmed to the downside with a target being this bottom purple area. And also the purple area, by the way, notice it's 420 something. And notice that we don't have green UFOs all the way to 420 something. So in other words, there is room for the market to fall more. And my expectation would be another strong push to the downside, a very fast one, probably to reach that Elliott wave projection level, and then the climate start being exhausted, and maybe another day or two and change back to blue, and then we are back to normal, if you wish. Because again, if we look at the behind the scenes, okay, if we look at the, let's call it market internals, if you wish, you can see how implied volatility for the calls is 17, implied volatility for the puts is 15. So from behind the scenes, there is more buying of calls and more selling of puts than buying of puts and selling of calls, which is bullish. Okay, and therefore that's the sentiment that is building up from behind the scenes. So So I read some articles in recent times where some people are predicting this to be the beginning of the new 2008. Could that be? Of course, this could be every day. But all the trades that we have in the portfolio are well under control. They all have limited risk, no matter what. Even if the market was to freeze for 3 days, the market was to fall to zero. So the most we can lose is limited, thanks to the option strategies that we use. So we are okay. We have some trades pointing to the long side, some trades pointing to the downside. So we are okay. And therefore, those human emotions that we all traders experience need to be kept under control, rely on mechanical and relevant data, which is calculated objectively by the computers. And in this case, we can see this is probably just a normal down climate, okay, that is going to last for a few candles. And could it be longer like the prior red climate? Yes, it could, but it's not likely. So no matter what just happened, which is a very lengthy red climate and a very short blue climate, no matter what just happened, just make sure you now don't you now develop some sort of a bias where now whatever values you read on the auto climate feel more bearish than what they actually are. Okay, we need to keep our mindset under control so we don't add a layer of interpretation on top of the objective data that the tools provide. So now that data becomes subjective because we are adding that interpretation. Okay, so everybody make sure you keep that thinking under control, because for sure in cases like this, especially in the past week or yesterday, all of those things are the recipe for human emotions to take over, and we gotta keep that under control. Okay, feel free to comment, guys, on what I just said. Maybe some of you had some sort of a temptation yesterday when you saw what happened, or the prior week is like, should I do this, should I do that, should I not do this anymore? This, my trading plan is suggesting take a trade, but I didn't because I was concerned. So if there is anything of that sort that you want to comment, we can talk about it, because this is indeed very important. By the way, talking about trading psychology, I hope all of you are registered for the webinar that we're running on Friday with Reynaldo. We're going to be talking about trader personality, and that's quite important, okay, no matter the asset that you trade. So make sure you are registered, and if for whatever reason you don't have the link, I can either put it here on the chat box later before the session is over, or you can just email me and I will email you the registration link. It's a free webinar, guys, okay? It's on Friday, and Reynaldo is my trading coach. So it's, you're in good hands there, okay? Cool. Joanne is talking to Maka. Very good. Very nice. Great. Perfect. Yes. Cool. Anyway, so now a bit more volatility. So there is concern kicking in the marketplace. Okay, so we are trading an implied volatility now of 22, 23, as you can see. We've hit that red UFO, volatility values started falling from there. Notice there is a green UFO right there as well. So again, there is plenty of premium built in compared to what we had last week, where we were trading around 18, 16 at times. So there is implied volatility. Okay, so you're probably guessing it, that my approach today is going to be to try to find trades with high volatility in the form of iron condors, so we can collect decent amount of premiums. Okay, so those are the type of trades that we'll be keen to put in place today. But before we do that, we now need to switch to the second item in our plan every time we run the sessions together, which is to review the trades that we have in place. Okay, how are you, Ahmed? Good to see you, my friend. Very nice. So we'll start with Intel. Okay, we will start with Intel, and to be honest, there is not much to discuss about Intel. It's doing a bit more of the same. So if we look at the 2D time frame that we used to plan the Intel trade, you may remember we got in at this moment in time. Then Intel was working very well. Then Intel became very challenging. A new UFO has formed, pushing Intel back up to the upside. So all of this is good, okay? But again, somewhere along this process, I believe it was about that day, okay? Somewhere there, we actually took Intel And I'm not going to go back to the beginning of this trade because it started, with two bull put spreads to buy a call, and I'm not going to go as far, but I will talk about this. Okay, there was a moment in time in this trade where we had a regular bull call spread made of the 57.5 call and the 60 call, and that 60 call was closed at 5 cents. You can see now in the current trade we don't have the call, we don't have the 60 call. The only call we have is the long 57.5 because the 60 call was closed. And if I show you think or swim, just to remind you, I still have an order here waiting to sell a new 60 call at 15 cents, which has not been possible so far, okay? Because even though Intel at some point went as high as this value right there, okay, whatever that was, about 55. So even though Intel went as high as 55, the 60 call never got 15 cents of value or more, and therefore our limit order was not filled. So we are still in that situation where we own a call that cost us nothing, and therefore the net profit of this trade so far is $10 per contract. Okay, am I using the midpoint? Yes, I'm using the midpoint. If you use the bidding price is 9.5, but again with the midpoint is 9.5. So yeah, so the trade is doing its thing. The only thing that we need here really is, we are approaching expiration date, which is October 15, and next thing you know, is looking, less and less probable for us to reach our target up here around 58. Okay, so if we look at probabilities of reaching those targets, and we look at October 15, which is right here. Okay, so October 15, given the current implied volatility, still implies that we may reach 57.87. Okay, so it's not like everything is lost and we are not going to reach the target. We could, but it's becoming, much and much and much less probable at this moment in time. Okay, so and the problem is that we cannot do too much about it. There would be, options to do butterflies, iron butterfly. We could do many things, but we cannot really do it here in this case because look, if I bring in an option chain for Intel using October 15 expiration date, which is the one we have. So, well, actually, this has changed. It was not like that before. So I'm glad I'm bringing this option chain. Let me load 10 strikes and see what we get. Yeah, so, well, actually, it's not helpful. So we, the one thing I was going to say is that above 57.5, we only had 60. So there were only very few strikes available. And I was going to say that doing an iron butterfly was not going to work because then I would need to sell the 60, and the 60 is trading for no premium. What happens as expiration date is approaching, more strikes has been released. So we got 58, 58 and a half, and that's good. It gives us more choices, but at the same time, we still don't have too many choices because notice that this is basically the maximum premium you would get, which is that. Okay, so we cannot do too much. Okay, if we were to think about doing a regular let me say that correctly, a regular iron butterfly. Now, let me explain what I mean by regular iron butterfly, because I'm going to try to do a less regular iron butterfly and see if that one works. Typically, if the regular doesn't, this one may not do so much better, but maybe yes. So we're going to assess that. So what I'm going to do is bring what we have left on the trade, which is that long call at no cost. I'm going to bring it back here. Okay, so long trade at no cost. Okay, this is the 57.5 call, which cost nothing because of everything we've done during the life of this trade. And what I'm going to do now is I'm going to try to create that original iron butterfly. Okay, now let me explain what I mean by original or regular iron butterfly. So let me make some space, with a little bit of white so I can type, and then I will expand this again. So a regular butterfly, if it's directional, okay, it's made of buy a call, and then you sell two calls, and then you buy a call. That's a regular iron butterfly. Directional butterfly. Okay, so if it's all calls, you typically use that to make money. Okay, and my intention was, we had we had, let me write it down, we had the 57.5 call. So my intention would be, I would love to be able to sell 2 calls above and buy 1 call, and that would create a directional trade, which now I would lower the cost. I would lower the cost even more because I'm selling 2 options and buying one which is further away, which means it's cheaper. So then I would add more credit to the trade, and then if we don't reach the target, at least instead of break even, it's going to be a profit. That's what I would like to do. But I cannot do that because, as we saw, the 58 call pays nothing. Okay. So what is my other choice, which is what I call original? I mean, not that original, but what would that be? Well, think about this. And you guys tell me if you have ever seen this before. So if you have a call above, and then you sell a call below, and then same strike, you sell a put, and then below you buy a put, what's the name of that option strategy? Anyone would like to share that? And I'll take a sip of water while I wait for your response. Okay, and today I'm ready to do this because it's we can still get to the target, but it's looking like very extreme, right? It's basically if the market moves all the way to what implied volatility suggests, then yes, but that's a lot of demand, right? No answers, my friends? You guys got shy? It's okay if you type the wrong answer. It's okay if you type the wrong answer. I'll give you a clue just to get you thinking. There are some times where we do a trade where you buy a call and sell a call above, and then you sell a put and buy a put below, right? And when this trade doesn't work well, okay, so then what we do is that one of the sides, we close it, and then we end up here rolling it down, okay, selling a call at that strike and buying a call at that strike, where if you think about what I just got here, isn't it the same as here? So now with that clue, what is the name of the strategies pointed by the arrow? You have seen it, Christian. The double Lindy. Very good. Yeah, not broken wing. I mean, we could broke the wing. Broken wing really sounds very sophisticated. Basically, it just means that one of the strikes is not equal distance. Very good, Maka. It's an iron butterfly, which, by the way, could be a broken wing iron butterfly, just like it could be a broken wing iron condor, or just a balanced broken wing. Broken balanced iron butterfly or balanced iron condor. Broken wing just basically means that that call or that put is further away, is not equal distance. That's what broken wing means. Okay, it sounds again more complicated than what it is. So yeah, it's an iron butterfly. Okay, so in my mind, because this is a directional trade. Okay, because it's a directional trade. Remember, what I would love to do is this. Right, take our 57.5 call, sell 2 calls above, buy a call above, and that becomes a directional butterfly where I lower the cost, but I'm still bullish. If the stock moves higher, which again, remember, Intel belongs to a strong industry, all of those things, even though, of course, the S&P has been dropping hard, right? And especially the week before. So then the stock didn't go too far because stocks depend on the overall market conditions. So it's all explainable. But at the same time, I would love to be able to be exposed to be bullish because that stock is bullish. It's a bullish play. But I cannot because I don't get premium. So what's my other choice? Well, my other choice will be to move to a different strategy, which is to be neutral. Which being neutral means I would now go ahead and sell a call below, sell a put below, and buy a put below. And that now becomes, using the 57.5 call, which I already have, I'm just going to add these 3 units. And now this becomes an iron butterfly, meaning that I am adding a credit to the trade. I'm making the trade to be non-directional. And then accepting or rejecting the trade will depend on the risk and the reward of the trade. Okay, we may end up realizing that then now we are adding risk. If we're adding risk, I won't do it. But if the risk remains the same or better, then probably we will end up with a better profit if we do this switch instead of staying with the 57.5 call. Because if we don't reach that target, then that call basically will break even, which is our current cost, as you can see here. Which is 0. Okay, so sector red now. Yes, I get you. I get that. But we still the S&P is red as well, right? This is a bullish trade when a stock that belongs to a strong sector. So even though the climate is red, I would not feel wise to now become bearish the stock, because while the climate could be red, the stock belongs to a strong group. Okay, so I would prefer to maintain the bias, and if any, move to non-directional, but not to bearish, because it's too much of a change in opinion that, if you wish, I would be okay to do, but only when planning a new trade. If everything has changed for that industry and everything else, I'd be happy to change my opinion. But I am still managing my trade, so I don't want to tweak my plan. Just trying to save the trade. I'm not trying to save the trade. I'm trying to find an optimal scenario which gives priority to the reduction of risk, which in this case there is no risk, is zero. And therefore, a next priority is make some profit on the trade to make it optimal, to grab something for us instead of just break even. That's the priority. I'm not going to try to now, like, okay, Intel, you disappointed me, you didn't make much money for us, now I'm going to short you, right? So, and I'm not saying, I'm going a bit too far here with that way to approach it. I don't think that's what you meant at all, Christian. But again, I'm trying to make you understand my thinking here from the point of view of, I'm going to respect my plan beginning to the end. And if I'm entering a new trade, then it's a different story. It's going to be a different plan. Okay, but this trade, I'm going to try to respect my plan. So let's do it. So we need to add a few more legs. Okay, to be precise, we need 3 legs below, right? The 2 in the middle are going to be to sell. Okay, it's going to be a call and a put, and the one below is going to be a put to buy. So right now, and I'm going to re-explain that very quickly. Yes, I got you. You meant AutoClimate. I totally got you. But again, the AutoClimate refers to that stock, not the industry. Okay, and while it's tremendously important to understand the climate when you trade, remember, stocks are fragile. Look at what happened to Intel, which was a strong stock in a strong industry in a blue climate. What did happen to Intel? It went down. It didn't go up. Why? Because the S&P went down. So the external factors are extremely powerful to influence stocks, and therefore I'm going to rely on that more heavily than on the climate for one specific stock only. Okay, if it was futures or forex, it would be a different story, because the euro got life by itself, right? If you look at currencies, if you look at crude oil is a commodity, and by itself it has its own life. But stocks may not be the right way to say it, but they don't have life by themselves. They depend on their industry and the S&P as an overall market condition. So that to me is more important than the climate for the stock itself. Okay, the climate for the stock itself is a condition for the filtering, for entering a trade and so on. But once I'm in it, the other factors are more important in order to manage the trade. Cool. Guys, long conversation, but absolutely needed, and very good, a very good one indeed. So what are we going to do? Okay, well, we got multiple strikes below 57.5, right? We got 57, 56.5. So my question is, so what if I sell the 57 call and the 57 put, and I buy the 56.5 put? So what if I do that? Okay, so I take one strike below and I sell a call and a put, and I take another strike below, and then I buy a put below. Therefore, they are equal distance. So this is a balanced iron butterfly. For the 3 strikes below, okay, I'm going to use the current price, which is the midpoint. For the strike above, which is the 57.5 call, I don't need to trade it. I already have it in my account, and the net cost of this trade right now is 0. So I'm gonna keep it like that, as field price is 0, but everything else is mid. So if I click OK, now I will be able to assess if this trade is acceptable or not. And so far it won't be, because I am adding risk. So now this trade becomes $55 of risk. Okay, so if the premium collected was high enough, okay, for this to become a credit, which is larger, okay, right now the credit would be 55. Okay, so if the credit was to be better than that, so then I would be delighted, but it's not the case. Okay, and therefore I would end up with a risk of 55, and that means I am increasing risk, which is not what I want to do. So what else can we do then? I'm going to do one more test, and if it doesn't improve the risk, then I'll stop and I will give up on it. So the next choice is move another strike down. So I'm gonna go for 56.5 and 56.5, and then that's $1 difference. So then I'm gonna have to move to 55.5. So I got 57.5 on the top, 56.5 in the middle, 55.5 in the bottom part. And if I do that, okay, so notice how the 57 call paid very little. So now the 56.5 should pay more, but the put should pay less. So let's try that and see if the risks improve or it doesn't. And it doesn't. So now we have more risk accumulated. We get more credit, but we also get more risk because the distance between strikes now is $1 instead of half a dollar. So, right? So it's not improving, and therefore it's not ideal at all. Okay. And again, I'm just gonna do it for fun, just so you see. The current price of Intel is 53.5. So if I was to go down all the way to 53.5, okay, I will get more premium, but the risk should be worse because now from 53.5 to 57.5, I got $4, right? So now to make it equal, I need to go to 49.5, which by the way is not available. So I'll do 50. So that's a broken wing iron butterfly because the distance is not $4, it's $3.50 below. And if I do that, I believe it's going to be worse now. But let's take a look. So now the risk is 200. Okay. Wait a minute. I may have read this wrongly, guys. Sorry for that. Yes, I read it wrongly, guys. I have a good news. Okay, I have a good news. We're going to be able to do it. I'm going to go back to my initial setup where I got 57.5 and 57 and 56.5. Sorry for that, guys, because this is confusing enough to do those tweaks. So if instead on top of that I made a little mistake, as I was explaining it. So then it gets more confusing. So sorry for that, but let me re-explain it. So what I've done now is I have re-added. Notice from top to bottom, 57.5 is above, 57 is in the middle, call and put, short, and 56.5 is below, right? So if I do that, how are you, Clive? Good to see you. If I do that, okay, I am going to collect 57 cents, right? And that's a credit, okay, and that is a credit. And because I am currently here already, okay, so notice what happens. If I look at the expiration line, notice that worst case, on the expiration date, you're gonna make $7.50. So in other words, because the credit collected, okay, it's more than the distance between strikes, okay, 57 is more than 50, right? 57 cents is more than 50 cents. So you're gonna make 7.5 cents of profit on the expiration date. So actually, what confused me for a moment was the fact that there is a minus sign, which means a credit. So I was just thinking about it straightforward, and I was not paying attention to the minus sign. That was my bad. So in other words, if we do nothing and we don't reach the target, okay, if we do nothing and we don't reach the target, so what's going to happen with this trade is that we're going to break even. If we do reach the target, then we're going to make a profit. But again, if we don't reach the target, which is what's more likely to happen, then you would break even. So what's one way to improve this? Well, one way to improve this is to convert it into an iron butterfly, because now if you do nothing, if you do the iron butterfly and you don't reach the target, so then you're going to make $7.50, which is better than nothing. Of course, you also need to account for, you need to spend $3 or, 3 times 50 cents or whatever you pay for with your broker for getting those 3 contracts filled. So it's not going to be net 7.5. You need to discount you need to reduce that amount by the commissions paid, right? So it's not a lot, but it creates a little bit of an improvement, okay? Now, if you get lucky and the stock reaches 57, okay, but 57 is below your target. The target was 58, okay? But 57 is the midpoint of the iron butterfly, which is where you get paid the most. And then now what you could make here, it's 110 in the particular case. Okay, so that it's indeed a better choice. Okay, but at the same time, I would prefer to explore other possibilities, as I was doing before, which is what if I go down one strike to 56 and a half and 56. So if I do that, so 57, 56 and a half and 56, correct? So yeah, so now in this case is not good. Okay, in this case is not good because let me see. Yeah, now I'm adding risk, as you can see here on the upper part. So if the stock was to really rally and reach 58, so when it gets to 58, you would be losing exactly $42. That would be the net risk of the trade if you were to reach 58, right? On the bottom part, instead of making $7.50, you will make $8. So it's about the same. And if I was to do it again and drop this by another 50 cents to 56, so 56 and 56, so that is $1.50. So now if I go back down to 54 and a half, so 54 and a half and 1.5 is 56, right? So now it's equal distance, it's a balanced iron condor. So if I was to do this, so now you can see that that is not helping at all now, because now you are adding risk. You would lose 16, and yeah, you would make again $125 if you end up meeting the target of 56. But currently we are trading at 53.54, which means that if nothing happens, you are basically going to lose those $16, which is worse than breaking even. So in other words, the best choice for this trade is to go for my first choice. That was 57, okay, and 56 and a half. Again, from top to bottom, 57 and a half is the call we already own. 57, it's the next strike. We're going to sell a call and sell a put. And then at the same distance, which is 50 cents, we're going to buy the 56 and a half put. And if we do that, again, that would produce, one more time, this risk profile, where worst case, we're going to make 7.5. And if we get very lucky, we're going to make that amount, which I believe I said wrongly earlier, is going to be about $56. Okay. So given the fact that reaching the target is quite unlikely at this point, so my preference would be to do that. Again, I'm not very happy we are only going to get 12 cents for that call, but hey, that's what it is. So that's the right choice given what we have. And again, it's not like we have embellished the trade that much, but that's what's available. Also, of course, because Intel is a $50 stock, which is not very high price point, so of course the premium you can collect is also limited. In the other hand, the benefit is that strike price increments are 50 cents at a time, so we have been able to squeeze as much as possible, given the fact the strikes are pretty close to each other. Okay, so we're gonna do that. We're gonna convert our directional play into a non-directional play, where we will probably basically be locking in $7.5. This is probably what's gonna happen. And I need to make another point as I do this trade, because there is risk of assignment if you do this, okay? And I need to talk about that so it's clear in your mind when you do it and what to expect. Yes, Mac, I was getting a credit. Clive, it's good to see you. Joe, expected move is less than $3. Maximum risk is 134. Does that mean that you are reducing your risk by that amount? I'm not sure where you see the minus 134. I am not sure where you see that. So let me do one thing, and that may help. No, it doesn't really help. I thought it would be just a bit helpful from a graphical point of view. Okay, just forget about it. So yeah, so here on the right, okay, what you can see is the risk characteristics of the short iron butterfly if you were to build it now. But in this case, because we already got multiple evolutions done by closing the initial puts and then selling a call and closing the call and all of these things, so really, in order to examine and assess better the reward and risk of this trade, you're gonna do much better by looking at the risk instead of looking at the values on the right. And it's pretty simple actually. Okay, so if I do this iron butterfly and nothing happens, let me do some writing. So you're gonna be owning the 57.5 call on top. You're gonna be short the 57 call and short the 57 put, and then below you're gonna be long the 56.5 put. Okay, that is the trade that I just constructed here. The current value for the stock is 53.5, which means way below 56.5. So if everything stays the same, which the worst case for an iron butterfly is to be below your put or above your call, okay? Staying in between means you profit. Staying above or staying below means you lose, okay? So the worst case, okay, the worst case, as I said, is to be either above or below. In this case, we are below. So let's say everything stays the same, which is a worst case. So what would happen to your trade? What would happen? Well, the 57.5 call, okay, that would expire worthless, okay, because it's an out of the money call, so it expires and that's it. The 57 call expires worthless, okay, because it's a call and it's out of the money, so it expires worthless. The 57 put, it's in the money, therefore you are put the stock to you at 57, and the 56.5 put is also in the money, so you are auto exercised. So you are assigned and auto exercised at the same time, meaning that you buy the stock at 57, you sell the stock at 56.5. So in other words, automatically you lose 50 cents. Okay, so you just lost 50 cents if nothing happens. But in exchange for you to lose 50 cents, you just got paid 57 cents. So if I added one more decimal place, which the platform is counting on that on the calculations, so what would happen on expiration date where you just made $7.50, which is 7.5 cents, which in this case we only see 7, but if I added another decimal place, it would be 0.575, right? So that's it, okay? So you may want to think about the credit you collect and the risk you're going to have, given the fact that you have done evolutions, okay? It's critical for you to understand if your strikes are in the money or out of the money, so you know if you're going to be exercised or not, if you're going to be assigned or not, okay? When I did the 56, okay? So when I did the 56, you could do the same math. So if you do 56, and then we did 54.5, okay? So the risk of the trade, okay, yeah, so that's what I meant, okay? Forget about this number in a case like this, okay? It's better for you to look at this number, okay? That number right there, okay? Why? Because, again, that's the math. So if we do the same thing, the distance between 56 and 54.5 is $1.50. So the worst case is to be assigned and auto-exercised automatically, and then you just lost $1.5. You lost $1.5, but you got paid 1.36 in order to lose 1.5. So what's your net result? $15 negative. Okay. So again, this is the theoretical risk of the trade, if you wish. Okay. But it's not like that in this particular case, because you got one of the strikes that is coming inherited from prior trades, where its cost happens to be 0, and is basically kind of confusing the platform. Okay, so that's why, you know, looking at it on the chart, it's a much better way to understand exactly what you got in your hands. Okay, so we're gonna do this. Okay, we're gonna do 57.5, 57, 56.5, and when we do this again, we are locking in $7.5, which is better than 0. And if the stock rallies and gets closer to 57, we may end up making more, and we'll be happy about that. So let's do it. I'm gonna cancel this 60 call on Intel, and this is a long conversation, guys. But again, these things are what will make you a very good, versatile options trader. So as market conditions change during the life of your trades, you'll be able to readapt and always find, you know, a smart tweak which sometimes will convert a losing trade into a profit or reduce a greater loss into a smaller loss. And that will, throughout the year, when you do that a bunch of times throughout the year, at the end of the year, it counts big time. So understanding this is indeed very advantageous. Okay, so if you have questions, let me know. I'm happy to repeat. I'm eager to get into trades, but at the same time, this is critical for you to understand. Okay, so now I need to get into a 3-leg trade. So to do that, I'm just gonna get a butterfly, because a butterfly, okay, not an iron butterfly, which is, where was the iron butterfly? Okay, he's not here. Okay, so using so many platforms, sometimes I get confused. A butterfly, it's a directional one, right? So it's made of 3 strikes. Okay, 3 strikes. So so what I'm gonna do is add this one here. Okay, is 3 strikes, and then what I'm gonna do is convert that to custom. So now I can make it exactly what I want. Okay, because what I want is sell 1 call, sell 1 put, and buy 1 put. I'm doing it from top to bottom, so it's less confusing. The call I'm going to sell is 57. The put I'm going to sell is 57. And the put I'm going to buy is 56.5. Again, if I bring float, right? If I bring my risk profile graph here on top of think or swim, I guess you are with me, that basically what I'm doing is I'm taking this bottom portion, which is what we want to add to convert my original call into an iron butterfly by adding 3 more strikes below, which is 57 call short, 57 put short, 56.5 put long. This will bring in a credit of 55 cents, which is what we're expecting here. Okay, so with that, I guess you guys had the chance to make a note, to follow me, to duplicate what I'm doing on your screen. So I guess you are with me on the process. I'm just going to place the order. I'm just going to try to get the 55, which is what's supposed to be available, and let's see if we got filled. And if not, I'll try to rectify this later. So price is 55. The mark is 57.5. So, I mean, it should be getting that 55 at some point. Again, this is a simulated account, so not sure what's going to happen. So I'm just going to wait a little bit. Or maybe I'm not going to wait. Please don't do what I'm about to do. You guys wait. You guys be more patient. I'm just going to go for, let's say, 50 and see what happens. Just so I can get this trade executed. And that way I can, that's it. We got filled at 52 in my case, okay? So I got 52 cents, which of course is less advantageous, but it doesn't matter to me. To me, what I want to do is I want to have those trades in front of you guys so you can see how I manage them and everything else. So you can see now I got 4 legs. I got an iron butterfly on Intel, okay? And therefore, I'm going to take these now. I'm going to enter the fill prices, right? So it's going to be 12 cents for the call, 365 for the put we sold, and 325 for the put we bought. So that is giving me those 52 cents. And now I'm just gonna right click and copy this position to the clipboard, and I'm gonna bring this to top, add a few lines under Intel and paste it. So now we can track our iron butterfly here, okay? And we'll be able to see how is it going, okay? So far again, instead of 9.5, we are losing a bit now. From 9.5, we are down to 4 because of the slippage acquired. But again, time decay will take care of that. And again, remember now we are guaranteeing, I got 52, so we are guaranteeing, $5 or $6 of profit on this trade, which is not amazing, but I'm giving myself the chance of either a little tinier profit or up to like $50 or so if the stocks rallies closer to 57, which remember the short strikes is where you will get the greatest profit. Okay, so this trade is in there, and again an important conversation we just had, and I need to add one more aspect in this conversation so you know what to expect from this trade, because there is risk of assignment now on this trade. So let me discuss that with you guys. Questions, Siderman. So what is the total amount that we would need in our account to cover the assignment? Very good. I'm going to talk about that now. Maka, so difference between iron fly and directional fly is it's 4 legs. Second is 3 legs. Depending on how you want to count legs. So the directional is 3 strikes, but the strike in the middle, you got 2 units. Okay, so the directional is, again, one more time, like you buy a call. If you do the call, you sell 2 calls, and then you buy a call. So you have 3 strikes, but the one in the middle, you have 2, so you have 4 units. 3 strikes, 4 units. You know, I would agree with calling that 3 legs. Okay, but it's 4 options. Okay, it's 4 units. With a iron butterfly is buy a call, sell the put, same strike, and then buy a put. So in this case, it's also 4 units. Okay, it's also 3 strikes. Okay, but now, you know, it would be more tempted to call it 4 legs because the units in the middle is one is a call, one is a put. So it's really 4 legs in both cases. Okay, but it's 3 strikes. You know, again, you will see that if you read options books, you will see it expressed in different ways. Some people will call legs different units. Some people will call legs different strikes. Okay, so you may want to call it 3 legs, 4 legs. You know, as long as you know how it's constructed, it's fine. This is, to be honest, a bit confusing because, again, especially in the literature, you may see it written differently. Yeah, Siderman, we need to cancel the 60 call because if you were to keep it up, and then you will be net short an extra call, and that carries an unlimited risk, which we don't want to assume. Maka, yeah, got it. I think I answered. Siderman, also we need to cancel. Yes, cancel. Yes. Oh, sorry. I thought you said don't need to cancel. Yes, we need to cancel, as I did. Very good. So that is directional if you have all calls or all puts. If it's all calls or all puts, is directional. If you do the mix of calls and puts, is non-directional. Even though the reality is that the risk profile will be the same. So depending on the strikes you select, you could actually do a directional butterfly to be a credit. And now I'm probably driving you crazy. We'll talk about those things, okay? But indeed, to keep it simple, it's better to think if it's all calls, you are directional long. If it's all puts, you are directional short. If it's a mix, you are non-directional. Okay? But again, from an equivalency point of view, you could make it, you can make it non-directional with all calls or all puts, or you can also do the arrow butterfly to be directional. So it's because of the equivalency in options trading, which depends on the strikes that you selected. So again, we will indeed talk about those things in those Sunday sessions that we'll be running one step at a time, okay? The beautiful world of options trading, isn't it? So many possibilities. Anyway, so let's talk about the risk of assignment and the risk of auto exercise, which again, I'm calling a risk because that's how it's written in the literature, but it's not necessarily a risk. It may be a great advantage, but there are implications, like Siderman suggesting margin required to do the trade, okay? So in this case, we are long a call, we are short a call, we are short a put, and then we are long a put. So while from a risk point of view, the worst thing to happen is to end up either above or below, in this case, 57.5 call or 56.5 put. So if the stock is either above or below the whole thing, it's the worst case from a performance point of view because you will make $7.50. You cannot make more than that. Okay? So it's the worst case. But from a convenience point of view, it's actually the best thing that could happen to you. Why? Because, if you are above, that means your puts are out of the money, so they expire worthless. This call is auto assign. I should not say auto assign, it's just assign. So you are short shares, and this call is auto exercised. So you are long shares, and short shares and long shares neutralize each other. So basically you are flat and you took your $7.5 of profit and you don't need to do anything, and it's all automatically done. Okay, so it's very simple when you are above or below, even though from a performance point of view is the worst case. It's assignment and auto exercise, so you don't need to do anything. There is no impact on the margin, and that's it. And the same thing happens if it's below. If you are below, the calls will expire worthless. This put will be assigned. This put will be auto-exercised. So you are flat, and you just collected your $7.5 of profit, and there is no margin implication or nothing at all. So end of the story. The best case is that you end up exactly at 57.00, which, by the way, this happened to me 2 weeks ago, where I had an options trade that was another butterfly, and the stock ended up trading at 0.00. This is the first time in my life this ever happened to me when I do an arrow butterfly, because the normal thing is that you end up either above this or below this. But what a coincidence to end up exactly at 0.00. It only happened to me once in my life as an options trader. But it did, right? So could it happen? Yes. It's very unlikely, but it could indeed happen. So what happens if the stock end up trading exactly right there? Well, then everything expires worthless. Everything expires worthless, and therefore those $55 we just collected are yours, and you just made the maximum profits, which is $55. That's it. Okay, that's it. End of the story. But that's very unlikely. Again, it happened to me only once, right? So it's very unlikely. So what's likely is that if the stock is not going to be above or below, then what's likely is that the stock is going to be somewhere in between here or somewhere in between here, right? In other words, above 57, above 56 and a half and below 57, or below 57 and a half and above 57, okay? Somewhere in between. So when that's the case, what happens? Well, if you are here, the call you sold would be assigned, but your call you bought won't. So what happens if you do nothing? If you do nothing, you will find yourself short 100 shares, after the market closes or the day after the market, in this case, it's a monthly expiration date, so it would be on Saturday. What if you end up in the bottom part? Well, the opposite is true. You would find yourself long 100 shares. Okay. Is this a problem? No. The only problem is the margin required. Okay. So, and when I say no, it's not a problem, we need to talk about this more because it could be a problem. Let me explain that better. Margin. Okay. Margin, I would say, should not be a problem because that stock is $57 times 100 shares. That means that you now require 57 and a half. If you're trading on margin, you need this divided by 2. Okay. So I would guess that, it's something that, we can survive. You should have that capital available in your account unless you are fully invested all the way, and that would not be recommendable, right? So I guess that should not be too much of a problem from a margins point of view. You may require, say, $3,000 of margin to be able to stay in this trade. So from that point of view, not an issue. And now, what's the issue? Okay, where could the risk come from, both if you end up short or long? Well, if you end up short and you do nothing about it, on Monday, the market may gap up. And now, when you close those 100 shares, you may need to close them for a loss. Okay, why? Because the gap up may imply a loss because you're short. What if you end up long and the market gaps down on Monday? Well, now you end up with a loss. Why? Because, the opposite is true, right? Because you're long, and if the market gaps down, the opposite is true. Now, could you be lucky and you end up long or short and the market gaps in your favor on Monday? Yes, you could. And this happened to us in trades from time to time, right? And then, congratulations, everybody's happy now. But again, we should not count on getting lucky. We should think of how can I mitigate and always have my risk under control. That's what we should be talking about, right? So in this sense, when you see the market is about to close on that Friday, and you see now that you have a very, very high chance to basically being assigned, and you are not going to end up beyond the upper or the bottom unit, in that space, right? But you're going to end up in between, right? So you should do something about it, okay? And there are different possibilities for you to explore depending on your preferences and so on. One which is very simple is go ahead and if you see you're gonna get short, like 15 seconds before the market closes, just buy 100 shares long. So you buy 100 shares long. So when you are automatically when you're assigned, so the short shares will neutralize the long shares, and then on Monday you're flat at the closing price of Friday, assuming that the closing price on Friday is going to be very similar to the price on Friday 15 seconds before the close. Same thing with long, right? So if you see you're about to get long, you can go get short 15 seconds before the market closes on Friday. So you are short, then you are you are put shares to you because you are assigned. So the long shares neutralize the short. You are flat on Monday at the closing at the price at which the market was trading 15 seconds before the close. Okay. Now, careful with getting short because the stock may be hard to borrow, and then you may not be able to go short. Okay. So then something you could do, which may be simpler. Okay, but that I would recommend you to do it before 15 seconds. Okay, just do it at least 5 to 10 minutes before the close. What you could do is, if you see you are about to get, let me try to delete a little bit of the writings. Okay, so if you see you are about to get short, okay, so what you could do, like 5 minutes before the close, something like that, just go ahead and buy a call. Buy a call that expires at a moment in time. Okay, same expiration date. Buy an in the money call. So if that's the 57 strike, you could go ahead and buy the 56.5 call. So then if you are assigned, you are guaranteed the call will also be auto exercised. So you are long at 56.5, you are short at 57, okay, and then they neutralize each other and you're out. And of course, the call you buy got intrinsic value, so you pay for the intrinsic value, so it's not going to make a profit. You're basically locking up your exit price not to suffer the gap risk on Monday. Okay, and the opposite is true if you're going to be assigned with the put side. So then what you want to do, because you're long, right? So you want to be short. So then you buy a put above the strike. So you would buy the 57.5 put that would basically sell you at 57.5 while the stock got you assigned at 57. Okay, so that way you neutralize the whole thing. Okay, but again, now with the puts and the calls, you don't have the problem of the stock is hard to borrow, but you have the problem of you may don't have liquidity into the closing of Friday. So that's why I said you may want to start doing it like 5 to 10 minutes before the close. So if you see that you don't get filled, then you need to move to the next expiration date, okay, next week expiration date. Do it with one extra expiration date and then close the whole thing on Monday. You would suffer a little bit of time decay, but now you are not exposed to gap risk. So that would be the way to mitigate the problem. And by the way, if you have a big gap on Monday, even though you suffered a little bit of time decay, because the option you bought has gamma positive, right? Every option that you buy is positive gamma. So then you're gonna have a little bit of a hedge against the gap, okay? And it's pretty okay. It's normally you are not getting that massive risk into your trade. So it's normally pretty okay, but ideally you would do it with the same expiration date. So that way, you don't suffer much time decay. Basically, you're just locking a clean exit of your trade and that's it. Okay. So guys, it's funny how in the end we spend the whole hour talking about the management of one trade. But again, these are important concepts for all of you to very well understand. Because when you get into advanced options trading, where you keep throwing contracts on top of contracts you had, and you keep converting trades into other things to keep managing your risk, improving the reward, defending yourself, when you start doing all of those things, you are adding complexity, and that complexity implies the risk of assignment. And again, I hate to say the risk of assignment because to me, assignment is not a bad thing, where risk is normally seen as a bad thing. But again, the risk of assignment is called risk for a reason. In this case, risk may be you end up with a gap. Okay, and we had cases in the past where we've done double diagonals, for example, and one of the short options got assigned, but we had a call or a put against it that would expire a few weeks later. And then I said, There's no risk there. The risk you had is whatever you had calculated before you took the trade, where you knew exactly what was your risk. So that's what you just got, okay, when you got assigned that risk, the one that was pre-calculated. But because you are either short shares or long shares and you got an option against it, you cannot lose more than that, even if there is a gap. So that's not a problem. But the problem in a case like this is that if you get assigned and you are in between, the call above and the put below expire at that time as you are being assigned. So you find yourself naked long shares or naked short shares. That's why you need to do something about it to mitigate the risk of a gap on Monday, because you don't have anything to protect yourself now. You are just long shares or short shares, and therefore you are now fully dependent on wherever the market does. And if it's a gap against you, that's problematic. Okay. So again, this may be a session. To be honest, I was so excited to go ahead and do some iron condor with high volatility, whatever. We may do that tomorrow. But at the same time, this is an important lesson, my friends. So I'm kind of happy that we went through this, because I know we talked about these things in the past. I know some of you got confused. Hopefully, and I'm sure some of you did pretty intense homework around it to clarify it. You may make notes, watch the videos again, everything else. But it was a long time we didn't talk about this. So I'm also pretty positive that some of the things were kind of like in the process of being a bit forgotten. And this needs to be crystal clear for the rest of your life as an options trader, because as you evolve positions, you will run into situations where now you are about to be assigned or auto-exercised. And now what? How do you protect against that? How do you define? What's the implication? Is it not a big deal, or is it a big deal? Is that gap against you going to hurt you or not? What's the margin implication? So those things should be crystal clear in your mind. And again, hopefully today, this was useful in that sense. And now you have another material to review, to think about, to make notes, to play up and down with the various possibilities, in that scenario. And I would like to suggest that you review this today. So when we are back tomorrow, because the session is basically over now. So when we are back tomorrow in the session, if you have questions, I would love you guys to phrase them so we can have a final clarification of this. And then, of course, speed of the light. I indeed have this burning desire to build, a few trades tomorrow so we can have them in the account, because I'm very excited about the fact that we got like multiple positions running in parallel now. Okay, and we got things to talk about. Okay, and I want to add more. So this becomes more and more and more how it should look like when you are managing a portfolio with multiple positions, directional long, directional short, non-directionals, long volatility, short volatility, all of those things. So Siderman, it seems to me if one end up long shares, one could just hold the shares since Intel is a strong stock in a strong sector, even if it gaps down. I get your point 100%, Siderman, but my answer to that is only if this is part of your plan. If it's kind of something that you do, like, it's kind of like you're watching your favorite sport, your favorite team, and they lost, and you're like, well, you have to resign yourself to that. And, and you find a hopeful way to resign yourself and hoping all is going to be okay. So I get it. And what you said is way more intelligent than what I just said, Siderman, because indeed it's a strong stock, a strong industry, strong company, all of those things. So at some point it should go higher. It also pays dividends, isn't it? So it's not a crazy thing to be done, but again, only if it's part of your plan. Because if the only reason why you do it is because you got assigned and you didn't have it under control, so you didn't act on whatever is part of your plan on that Friday before the market closed, so you don't suffer the consequences of a gap. And now you find yourself on Monday with a stock gapping against you, or even if it gaps in your favor, and now you're like, you know what, I'm just gonna keep it because it's a good company. And I'm not saying that's you, Siderman. I'm just saying that this could be a big temptation, isn't it? I mean, I'm sure you guys are with me, and feel free to admit on the chat box if that would be a temptation or not, because it would have been to me in early stages of my trading career. So, what I want to avoid is those temptations. Okay, so again, long story short, if it's part of your plan and you have reasons why you say, yes, I want to keep it, and you also know how much of your portfolio should be these type of trades, okay? How much percentage of your capital should be allocated in stocks that got put to you, or stocks that got called away and now you're short. Okay, how much of your capital should be involved in this type of trades? Because if you end up, let's say, being, I'm going to use a term I don't like, but you will get my point, just to keep it short because it's late. If you were to end up a bit unlucky and you end up with too many stocks of that sort in your account, now you are overexposed to that and you don't have it under control because you never thought about how much percent of my capital I want to use to be allocated into, long equity or long shares if they are put to me. You never thought about it, right? So my point is, think about it, decide if you want this to be part of your plan or not, and if so, how much percentage of your capital as a maximum. And if all of this is okay, so then doing it is not crazy, but at least now you have it under control, because even if a gap against you occurs, exactly that's not too bad for you because you limited how much percent of your portfolio is allowed to use that capital for long shares. Okay. Anyway, hopefully all of this makes sense. And Siderman, we are here to work together precisely to make us all more sophisticated. Those are important thoughts for you to think about. And there is no right or wrong. It's all about having a plan for whatever happens before it happens. So when it happens, you don't find yourself improvising, because that is the recipe of leaving a door open to additional risk that you didn't plan for. And that sooner or later will hurt an account. So as traders, we need to mitigate the risk every single time. That's the key. Okay. Even if we had a terrible methodology on how to trade, as long as you keep your psychology in the right place and the risk management is impeccable, there is a moment in time where your account will make some money. Okay. Even if your methodology is not too adequate, but because you manage the risk and you manage your emotions, at some point, things will start working for you, and maybe at a very slow pace and a very slow rate, and it's not even worth it to trade with a bad methodology, which, I would say, that's common sense. But at the same time, what I'm saying is that risk management and trading psychology is even more important than the methodology. So just keep that in mind. Okay, so don't trade. Even now we have top amazing tools, everything else. Do not underestimate the power of, that sounds like Star Wars, isn't it? Do not underestimate the power of risk management and trading psychology, guys. Okay, that's extremely powerful, more than the methods that we use, because the methods that we use, while they are very powerful, notice what just happened on the S&P. Something totally unexpected, with this red climate lasting for longer than expected. So what if you didn't have the risk under control? What would have happened to the account? Okay, our positions right now are not doing too well. They are not doing too well. But look at the pain we accumulated. $167. Not a big deal. Okay? The amount of money made during the year with the tiny positions I've taken, because I only take one contract every time, 1,300. Now we are suffering 169 when the market has behaved in a way that is totally unexpected. Could you survive that? Yes. That's the point. So now, of course, if I had been more active, well, we are only meeting twice a week. If I had been more active, other trades would have added it, some additional profits, and probably the minus 168 would actually be positive. But again, that's my point. Even if the methodology was not the best, in this case because of lack of activity, the risk management is what keeps you alive. And when the market makes your methodology work well, so next thing you know, now you start profiting and you are in the green. Okay, so it's critical. And I'm sorry to sometimes phrase something and repeat something multiple times, where I could just maybe summarize it in a quick sentence, putting on the side that you guys know me well. I do like to expand my explanations, and I do talk. Okay, putting that on the side, this is such an important topic where I don't mind to extend this explanation for longer, including repeating multiple times what I've said using different words. So it really truly clicks, because my friends, this is the secret of success. Okay, managing your emotions and managing your risk management, and then of course you add a powerful methodology, and now it's going to make the difference with performance. But without the initial components, it's a problem. Okay. Anyway, my friends, love spending time with you guys. A little bit of a different session today than what I had anticipated, to be honest, even though I was planning to talk about the butterfly and Intel, but for whatever reason, I thought I would end up explaining that very quickly, and then it took the whole hour. So anyway, hopefully you guys have learned a few new things today, and this was useful to you guys. Looking forward to seeing you tomorrow, and tomorrow we need to get into trades. Okay, so I'll be a bit more straight to the point. You guys take care. See you tomorrow. Bye bye, everyone. Take care. Thank you, Wayne. Thanks, everyone. Thanks, Willie. Bye bye, everybody. Bye, Ahmed, Christian. Bye bye. Take care.